Ladies and gentlemen, good day and welcome to Poonawalla Fincorp Limited's Q3FY22 Earnings Conference Call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Kunal Shah from ICICI Securities Limited. Thank you and over to you, sir.
Thank you, Janice, and good morning everyone present on the call. Today we have with us Mr. Vijay Deshwal, Group Chief Executive Officer, Mr. Sanjay Miranka, Group Chief Financial Officer, Mr. Manish Jaiswal, MD and CEO of Poonawalla Housing Finance, Mr. Rajiv Kumaraswamy, MD and CEO of Magma HPI, and Mr. Mahendra Bagrodia, Head Collections from Poonawalla Fincorp, to discuss their third quarter as well as 9 months FY22 earnings. So over to you, sir.
Good morning, Kunal, and good morning, everyone. I welcome you all on behalf of the Poonawalla team for joining the Q3 investor call. I hope and pray that you and your loved ones are safe and healthy. The management team here at Poonawalla Fincorp is excited to share the updates on an eventful quarter gone by. We continue to look forward to building a long-term and sustainable relationship with the capital market community, analysts, and all our shareholders. We will take it up into first. I will share with you the major updates related to business and our transformation journey. And then I'll hand over to our Group CFO Sanjay, who will discuss the financial results for the quarter in detail. And thereafter, we will request you to take up any questions. Let me begin with the economic background prevailing during Q3. While we witnessed the Indian economy gaining momentum in October and November, the same was challenged a bit due to the rising COVID-19 infections towards the end of December, prompting the authorities to bring back some restrictions. This created a little bit of uncertainty regarding the growth. However, the good news is that the new wave has turned out to be less threatening than the previous ones. The GDP growth forecast for FY22 has been pegged at 9.5% by the RBI, which is well supported by all the macroeconomic indicators like GST collections, which have been clocking above 1.3 lakh crores every month in the last 4 months, the CV sales and the others. In light of the above, our business continued to gain traction during the quarter with organic disbursements growing by 28% year-on-year and 19% quarter-on-quarter. While we consolidated our AUM, it remained flat due to rundown of the discontinued portfolio. Our focus book grew by 6% quarter-on-quarter. As highlighted previously, our focused lending segments continue to be consumer and small businesses. Our current offerings consist of secured products including pre-owned car loans, SME LAP and affordable housing, and unsecured products including personal loans, loans to professionals and business. Even as we continue to sharpen our branch and digital distribution infra, during the quarter we entered into multiple fintech partnerships to enhance our reach and build a quality book. We also added small ticket LAP and medical equipment loan products to our portfolio. Within our overall customer segment, we will keep evaluating new products and partnerships and launch them at an opportune time after evaluating these on our defined matrix of scalability, operating profit, and credit costs. Earlier, we decided to discontinue some products in the previous forms for specific reasons that we had explained earlier. The discontinued book now forms about 24% of our AUM and is expected to run down substantially over the next 24 months. Our endeavor is to continue to build a portfolio with a healthy mix of secured and unsecured products, giving us superior risk-adjusted return. Let me now give you some updates on the key operating levers that we have defined in our strategy and that I talked about in our previous calls. First and foremost, our brand, equity, capital, and COF. We continue to benefit from the brand and backing of a strong group coupled with our strong capital position. I am also pleased to inform that during the last few days, we have received a long-term credit rating of AA+ stable from CRISIL, along with reaffirmation from the other rating agencies. This is followed by a AA+ stable credit enhancement from CARE in the month of August. This has enabled us to further diversify our lender base and keep our cost of funds highly competitive. We have diversified our fundraising from the banks, which was largely earlier within the PSU banks, to now a range of foreign banks and private sector banks with very large lines coming through. We'll continue to strengthen our liability mix with the banks, debt capital markets, long-term finance institutions, including refinance, and continue to optimize our costs. The second lever, the senior leadership team. I am happy to share with you that entire senior leadership setup is largely complete. Given the rich experience of the team, we are confident of delivering the ambitious business plans that we have envisaged. The third, which is our distribution infrastructure, we continue to leverage on our pan-India branch infra, along with enhancing our digital capabilities. The process of branch rationalization is in alignment with the new product strategy, and it has continued. For the newly launched SME LAP product, we have operationalized 38 out of 65 identified locations and have onboarded 600+ channels. We have also expanded our presence in the unsecured businesses, which are personal loans, business loans, and loans to professionals, to about 97 locations now, up from 59 in Q2. In affordable housing as well, we have expanded our footprint to 113 in Q3 from 103 in Q2. This apart, we have enhanced our reach through various fintech partnerships, as I mentioned, which went live during the quarter. In terms of our digital strategy, which is another pillar of our growth, it's at the core of our overall business strategy, where tech and analytics will drive product innovation, direct customer acquisition, improve tech, and provide data for analytics to further serve the customer better. We continue to develop end-to-end digital journeys for our products. I'm happy to share that our unsecured products, which were already on an end-to-end digital journey from onboarding to disbursement, now a similar digital approach for our newly launched SME LAP product has been kicked in, and it's making rapid progress on all other products. Our tech architecture is gearing up towards supporting multiple products and integrating with partners in a seamless fashion. On the analytics front, we continue to develop tools for sourcing, credit underwriting, risk monitoring, and collections. We expect all these to bring cost efficiencies, expand our reach, improve customer experience, make our credit decisioning consistent, and collections more efficient. On asset quality and credit cost, I'll now maybe share a little bit about how the quarter gone by. Our collections efficiency continued to witness improvement during Q3 across all the products. During the quarter, we sustained a healthy collection efficiency above the pre-COVID levels and achieved above 99% for the month of December. We continued our efforts on collections, and we were able to reduce our stage 2 and stage 3 book quarter on quarter. We continue to make significant recoveries from the written-off pools and are adequately provided at this stage. In November 2021, all of you are aware that RBI notified revised NPA recognition and upgradation norms for NBFCs. It was more of a clarification than revised norms, I would say. The impact of this for Poonawalla Fincorp will be an increase in GNPA by about 552 crores compared to gross stage 3 at a Concall level. It's worth noting that this pool of assets registered a collection efficiency of about 107% in December, and we continue to follow the Ind AS provisioning, and the same remains higher compared to the requirements under IRAC. Also pleased to share that our bucket movement, which is a real factor or showing the economic value of the assets, it has improved consistently. So therefore, we don't see any impact of these norms other than regulatory reporting on the asset quality and provisioning. Credit costs for Q3 have reduced substantially both quarter-on-quarter and year-on-year due to combination of lower slippages, write-backs due to improvement in bucket position, some release of the COVID provisions due to improving collection efficiencies. Moving on to key highlights for Q3 performance before Sanjay takes you through it in detail. Our consolidated AUM remained at about 15,228 crores. The AUM of focused products grew by 6% quarter-on-quarter. Disbursements witnessed healthy traction across all active product lines aided by improving macros. Book growth had an offsetting impact due to the rundown of the discontinued product book. NIM improved by 25 basis points year-on-year, aided by sharp reduction in cost of borrowing. This, coupled with very sharp reduction in credit costs, led to a healthy growth in PBT from our lending businesses, which came in at about 138 crores. I'll now hand over to Sanjay, our Group CFO, to take you through the financial update in detail. Thank you.
Thanks, Vijay. Good morning, everyone. I'm pleased to share the update on the financial performance of Poonawalla Fincorp Limited for the third quarter, which has been an eventful quarter to say the least. Our consolidated AUM was at rupees 15,228 crore, staying at a similar level on quarter-on-quarter basis. However, the AUM of focused products grew by 6% quarter-on-quarter, which is encouraging. We saw good traction across all our active product lines, with organic disbursements growing 28% YOY and 19% quarter-on-quarter. Quarterly NIM improved by 25 basis points YOY to 8.8%. Our normalized NIM were 9%. We continued to engage with banks and achieved repricing of all eligible term loans. We have continued to expand our lender base, with majority of the incremental borrowing in Q3 coming from foreign and private banks. We also tapped the capital markets and raised funds through issuance of commercial paper. We are raising funds at one of the finest rates in the industry. Further assignment of AA+ stable rating by CRISIL to both PFL as well as PHFL is expected to strengthen our capital market presence. Since our last call, we have received fresh term loan sanction of about rupees 4,000 crore at an average rate of 6.3%. On quarter-on-quarter basis, our normalized cost of borrowing declined by around 100 basis points in Q3 to 8%. On the OPEX front, there was an increase to 5.1% compared to 4.8% in Q2 on account of capacity building done in line with the growth strategy. The OPEX is likely to normalize with growth in business over time. Talking about our ALM and update on liability management, we have an extremely comfortable liquidity of over 4,500 crore and surplus ALM across all the buckets as on December 31st, 2021. The growth rate declined sharply by 340 basis points YOY and 60 basis points quarter-on-quarter to 3.5%. On similar lines, the net stage 3 book declined by 270 basis points YOY and 20 basis points quarter-on-quarter to 1.8%. The credit cost stood at nearly zero, 480 basis points lower YOY and 100 basis points lower quarter-on-quarter basis. Our structured portfolio improved to 5.7% of AUM in December 21 vis-a-vis 5.9% in September 21, aided by recoveries. The collection efficiency continued to surpass pre-COVID levels and was above 99% for December 21. The bucket position of the book also improved, with stage 1 proportion improving both YOY and quarter-on-quarter basis, indicating overall improvement in asset quality. As on 31st December 21, our provision coverage on stage 3 book stands at over 50%. We are also carrying a provision cover of about 16% on stage 2 book, which is quite healthy. As on 31st December 2021, we are carrying about 134 crore of specific COVID provision. There has also been some recovery from pool during the quarter. Our conservative provisioning basis revised policy sustained improvement in the collection efficiency, reduced slippages, and further expected recovery from write-off pool provides enough cushion and help bring down the credit cost for rest of the year. We would strive to achieve net stage 3 percentage of less than 1.5% by the end of financial year. During quarter 3, PFL accepted binding offer for sale of its shareholding its joint venture company Megma SDI General Insurance and Jaguar Advisory Services Private Limited, which has been approved by the Board of Directors on 2nd November 2021 and also by its shareholders on 13th December 2021. The said transactions are subject to requisite regulatory approvals. Accordingly, as required by Ind AS 105, these investments have been presented as non-current assets held for sale, and share of profit of the joint ventures have been considered up to the relevant date. Consequently, we are highlighting profit figures for the lending business along with the consolidated figures. So, our consolidated PBT for the lending businesses in Q3 FY22 was at 136 crore against 17 crore achieved in Q3 FY21 and 124 crore in Q2 of FY22, witnessing a significant 700% YOY growth and 10% quarter-on-quarter growth. The profit after tax for the lending business has increased to 102 crore against 13 crore in Q3 FY21 and 93 crore achieved in Q2 of this year. Our ROA for lending businesses increased to 2.7%. Thank you. Over to you, Kunal.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kunal Shah from ICICI Securities. Please go ahead, sir.
Yeah, hi sir. So with this rollout of new products as well as maybe in the existing one, if you can just highlight in terms of how the initial experience has been, both in terms of the acceptability and even in terms of scale up, some of the product segments would have surprised positively, and you have highlighted right to win. So what is the key differentiation which you are seeing in the market with respect to those products? So if you can just give some granular detail on the focus product segment, that would help. Yeah.
So Kunal, thanks for the detailed question, and I'll take it up into 2 parts. First, on the specific focus product segments. As we spoke, pre-owned cars, we got into some partnerships, and we also revived our branch distribution engine. So we have reached a run rate of about 110 crores per month on the pre-owned car, which is almost back to pre-COVID levels. We had defined that from partnerships, we aim to have a contribution of about 10% to our total distribution engine. I am pleased to share that only with the first partnership, which is Cars24, we are able to clock in almost 7 crores per month in a very short span of time of 1 month. The positive thing here was that we were geared up with our tech stack. We were ready for integration, and we have ensured that the entire process is end-to-end digital, as we have committed to ourselves and also to the entire process and to our customers. So this is what was worth highlighting. In terms of other relationships there, we are at advanced stages of discussion with various other large online aggregators on this product, and our aim to have a contribution of 10 to 15% of the business coming from these channels. I mean, it may actually come sooner than later in terms of overall composition, and we are very confident of that. Looking at the other products like personal loans, business loans, and the unsecured piece of it, we partnered with Paisa Bazaar in the last quarter, and we are seeing a good traction in terms of whatever fits our credit filters. So what we have made sure is that whatever partnership we do, the BRE remains ours. So we don't dilute the credit underwriting standards. We rather create a STP process which helps in a reduced TAT and helps in terms of overall delivery of the product in a faster time and with the pre-approved credit matrix. In terms of our loan against property, the SME LAP which we launched in the last quarter, initial 2 months have gone by. I'm happy to share that out of the 65 locations, more than 50% have been activated with over 600 plus channels which have been activated now. And the traction for the business is gaining momentum. As you know that when you start any new business, the market also tests you. So we are going through those tests and we are building up a business which is quite sustainable. If I share some numbers, I mean, we have reached a number of almost about 40 crores a month in terms of run rate within a short span of time of about 2 months on this business.
Sure. Yeah, this was helpful. And in terms of the differentiation and maybe the distribution apart from the online, if you can share a bit say both the internal as well as the outsourced channels and the acceptability out there.
So differentiation, both when I talk about partnerships and our own channel distribution, we are endeavoring that everything happens end-to-end paperless. So while you will appreciate that in a environment of credit underwriting of collateral properties, which is LAP, the physical properties continue to be sort of evaluated through the legal and technical framework on a physical basis, but the entire application right from the channel onboarding, application login, credit assessment and disposal, everything happens online in a digital format, which we feel is giving a large comfort to our channel as well as the partnerships that we have engaged with. So that's a small differentiation, if we may call it, is what we have looked forward to.
Sure. Thanks a lot.
Thank you. The next question is from the line of Chirag Sureka from TSP Mutual Fund. Please go ahead.
Hi, this is Vivek Ramakrishnan. I had a few data keeping questions and one rather strategic question. In terms of how do we see Poonawalla Fincorp in terms of geographies going forward? You mentioned about products because the NBFC space seems a crowded space and many of the players seem to be doing the same thing. Would your competitive edge be driven by the fact that you have a strong backing, low leverage, and low cost of funding, or what would be if we look at it 3 years from now, what would we say Poonawalla Fincorp would be? That would be the strategic question. In terms of the data keeping questions, if you could give us the discontinued products in the restructured pool, as well as the write-off pool, what is the quantum that is there and how much recovery that you expect from them in the next few quarters? Are the customers able to pay at least EMIs at this point of time? Thank you.
So Vivek, I'll take the first question in terms of the overall strategy and how do we see or how will one see Poonawalla Fincorp emerge over a period of time. And then in terms of the numbers, I'll request Sanjay to dabble a little bit more into that. So we have a stated objective of being a diversified tech-enabled NBFC focused on risk-calibrated growth with customer-centric approach, providing a growth-oriented environment for its people and creating value for the shareholders. That's the larger stated objective. You also had another question imbibed into it, Vivek, that how do we see the geographical expansion? Because we spoke about products, we wanted to understand a little bit about geography. So as a baseline, I'll share something with you that over the last number of years, while we were strong in northern part of India, We were also strong in the central part of India, and in south, other than Chennai, we were good in Andhra, Telangana, Karnataka, and Kerala. So the markets where we are focusing more, and we intend to build or rationalize the geographical expansion, will be Tamil Nadu, Maharashtra, and Gujarat. And on a steady state, maybe over a number of years, the way the market opportunity offers itself, our share of market also will be something similar what is there for the larger players, which if you look at East will be contributing less than 15%, and there will be almost an equal distribution between North and West, followed by South. This is how we look forward to our future. And Vivek, pardon, but we missed your second part of the question. If you can repeat, then Sanjay will answer specifics on the numbers.
Sure. Thank you for that. So just one add-on question to the first question itself is, it'll be like a semi-urban tier 2, tier 3 cities would be the focus for you?
So we will have urban and semi-urban focus, Vivek. We will not have too much of a rural focus. So this is how, and that's in line with the customer segments that we have defined and the geographies.
Sure, it makes sense. So, sorry, the second question I'll repeat again. In terms of the restructured pool that you have, how much of it is part of the discontinued pool? And the same question is also in terms of the write-off pool. What is the write-off pool that you have, and what can we expect as recoveries from this pool going forward? Are the customers at least be able to, if not for a one-time settlement, able to pay single EMIs and they won't become current, but at least your money will come back?
Yeah. So, our write-off, our restructured portfolio is 5.7%. Okay, this number was 5.9%, so it has come down, and which obviously reflects that okay, there are recoveries happening even on the restructured pool. The second question you had on the write-off. In fact, on our write-off book also, we recovered 230 crore in the past 9 months, and a larger part of that recovery obviously has been in Q2 and Q3. Because we have gone for quite conservative and stringent provisioning and write-off policy, yeah, obviously the recovery okay tends to be quite decent. And as we talked about okay in our opening remarks, even go forward we expect write-off recovery okay to remain robust.
Sure, sir. What is the quantum of the write-off pool? That's what I wanted to know. Still remaining, where you can recover?
So we'll come back. I don't have that number handy.
No problem.
Yeah, we'll come back with that.
Thank you very much, and good luck, sir.
Thank you.
The next question is from the line of Rajesh Kothari from AlfAccurate Advisors. Please go ahead.
Good afternoon, sir. So my first question is, you target to grow AUM about 3 times by FY25. So right now we are almost March 22 is completing. So 23, 24, and 25. Correct me if I'm wrong. There's 3-year target, correct? And March 21, our AUM was roughly about 14,000 crores. So from 14,000 crores to 45,000 crores, roughly 42 to 45,000 crores. So can you tell us, from where this, how do you see the your AUM mix over a period of 3 years, and how should we look at your company, because it is an explosive growth, correct? What should be the milestones which one need to look at it, say by March 23 and then 24 and 25? Can you just take us through that? And consequently, as you grow from 14,000 crores to 45,000 crores, your ROA from current level, depending upon what kind of mix you are targeting, how do you see that to move over the time frame?
So the way we are looking at our growth is on a steady state. After 3.5 years, you will see a secured to unsecured mix of about 65 to 35. So we'll be having a book of about 65% secured book, which will constitute SME LAP, our housing book, our small ticket LAP, and our pre-owned car finance, and maybe a little bit of the machinery and the medical equipment loans. On the unsecured side, we will have business loans, personal loans, and loans to professionals as a large category of the unsecured piece. So this is how the mix would really look like. If you look at the AUM numbers picking up and how do we traverse the distance from current 15,228 to say about 40,000 crores plus over the next 3 years. So next year FY23 we should be closing the book upwards of 21,000 crores, and thereafter you can take the trajectory at a 30-32% CAGR. See, one thing we need to understand that even as we speak today, we have reached a number of about 55 to 60% of desired monthly run rate in terms of disbursement, and we are looking at almost 80% by the month of March. However, because we still have almost 3,600 crores of book which will continue to run down, and that business we are not doing anymore, so that does not allow a significant ramp up in the initial year or so. However, subsequently as the new business lines kick in, these are the numbers that you can look forward to. In terms of ROA, we are at about 2.6% right now. We have stated that we will strive to achieve an ROA anywhere between 3 to 3.5% on a steady state over the next 3 years.
So, you mentioned that, you are at roughly, I missed that number, 60% of your desired monthly disbursement.
Yeah.
So that desired, monthly, disbursement is basically you are saying target for FY25 target for FY24 or 23. I mean, what is when you say desired means, can you elaborate on that?
Is what I would expect you to know.
So for a 23 AUM of 21,000 crores, which would also have some rundown impact and all that stuff, what would be your target disbursement for FY23?
You can safely assume somewhere around 12,000 crores for the full year.
12,000 crores. And what was your, sorry, I don't have presentation in front of me. What was your third quarter disbursement?
1,550 crores of organic disbursement.
Sorry?
1,545 crores of organic disbursement and total of 1,845.
Okay, so total of 8. So basically you are saying, full year you are looking at 12,000 crore, but of course there would be also, loan repayment as well, am I right? So this would be on the gross basis disbursement, what you are talking about.
See, what we'll do is we'll engage more in person if you want to go through more of the details. What I've given you is directionally, because it will be unfair to really get into micro calculations on a monthly basis. So what we can do is that we are targeting a monthly run rate of 1,000 crores per month by the month of say April, and as we told, which is demonstrated in the numbers itself, we are already at about 550 to 600 crores a month.
Okay, sir, my second question is, with reference to the, the digital and the technology enabled kind of thing. So can you tell us that, total how many people are working under the, the digital, what I would say, the technology, division of your firm, and how you plan to further enhance the resources in this space?
On the tech team, we have about 75 people who are deployed right now. On the digital piece, we have about 25 people. And these numbers on the digital may double from here. So we may have a team of about 50 over the next 3 to 6 months. And on tech also, you can see that about 125 to 150 engineers working on building a very strong tech stack. So that work has already started, and that's the numbers.
And do you outsource, a lot of technology, app development, etc., or you primarily do more of it in-house?
See, everything is opportunistic and through the measure of go-to-market. So whatever we need and we need to definitely develop in-house, we are working on those. But if there is a need to outsource something to reduce the go-to-market, we will continue to evaluate that and do it.
Perfect, sir. I'll come back in queue. Thank you. Thank you very much. Wish you all the best.
Thank you.
Thank you. The next question is from the line of Harshvardhan Agarwal from IDFC AMC. Please go ahead.
Hi, sir. Thanks for the opportunity. So just one data keeping question. Wanted to understand, is there any overlap between the restructure book that we have and the RBI GNPA book that we said of 550 crores? So is there any overlap between the two?
No.
Okay. So these two books are mutually exclusive.
Yes. Yes.
Sure. Thanks a lot, sir.
Thank you. The next question is from the line of Tejas Mehta from Omkara Capital. Please go ahead.
Yeah, hi. Thanks for taking my question. So number one question is, if you can give us a breakup of the entire loan mix, segment by segment. Hello?
Yeah. So if you look at the slide, just a sec. In investor deck, we have included a slide number 20. Yeah, it talks about the segment-wise, basically security-wise mix of the book. So our book which is secured by hard collateral, it was 34%. Book secured by movable collateral was 51%, and unsecured portion was 16%. And as you can see, the book which is secured by hard collateral has been going up over the last 5 quarters, and also so is the case with unsecured.
Yeah, so I saw this slide, but I wanted to understand how much is LAP, how much is home loan, how much is pre-owned cars, all of those segments. If you can give a breakup of that.
Yeah, so maybe we can connect later. Yeah.
Okay, sure.
So that we are able to kind of address the larger questions on this call.
No problem, sure. The second question is, you mentioned that your discontinued book AUM is about 3,600 crores.
Yeah, that's right.
What is the NPL on this bucket?
So see, the good part is that our discontinued book is behaving pretty well. And with the 24% of the book being discontinued, otherwise you would not have seen the kind of collection efficiency and the bucket improvement, which has been visible across last few quarters. So even the discontinued book is behaving quite well. I hope that would be suffice to say. I won't have specific GS3 numbers for continued book, but the collection efficiency even of discontinued book is quite healthy.
Got it. And the last question from my end would be, on the tech and the digital platform. Now, every lender these days talk about the tech and the digital platform that they have built, including the fintechs as well as players, the bigger players in the NBFC space. What is it that you are doing differently versus the other players?
See, I'll share, Harsh, right? I'll share what is the mission that we have in terms of digital, then what are our foundational principles, and what exactly we are really doing, and I'll try to see if I can do justice to this question. So we are looking at building digital and tech stack for delivering digital first. That's the clear vision. Deliver top quartile cost to income ratio by using digital. Digital has to eventually result into lower cost of acquisition and improved ROAs. To help a branch-light customer model that we have very clearly stated, which eventually also dabbles into a digital collection infrastructure. And we deliver a top 10 digital primary call. That's our ambition. Then what are the foundational principles of this? So first and foremost, through digital and tech stack, as I said, our cost of acquisition has to be low. It can only happen if we achieve a significant decongestion in the processes. And by decongestion, I mean that we target almost 100% straight through processing for the onboarding of customers, led or backed by automated VREs for quick decisioning. And we also look forward to therefore engage with the partners who are equally sharp on the digital stack and to invest in the customer success. This overall, if we really look at it, will help us deliver the risk-adjusted growth that we have really taken an ambition on. Now, to build a complete tech stack and digital capability to deliver 100% STP, it will be a journey. However, what we have seen our initial experience in terms of rolling out of 100% BREs across all the products, we are seeing a significant traction, a significant reduction in TAT, and improvement in terms of the decongestion that we really talk about. So this is the overall thought process. On tech stack, of course, again, it will be a journey where from where we are and to what we really aim at. So basically, we are looking at optimizing and automating through the STP as we spoke about to support the new product lines that we create and also integrate seamlessly with the partners that we intend to. And this will cut across not only sourcing, not only acquisition, but also to underwriting and to collections. So that's the overall ambition we have, and the journey has already started in that direction.
Fantastic. So, sir, just one last question. Where do you hire your talent for the tech and the digital team?
See, we are actually see a little bit difference between the core tech stack teams and the digital. The digital is more from the ecosystem of digital, which is there, how the markets have evolved over the last 4-5 years, and you know that most of this talent right now is sitting in the fintechs and the like. If you look at tech, we are looking at hardcore engineers who have experience in product development in the large IT companies and also who appreciate the banking and finance part of it. So that's how, and also, I mean, we encourage people who are at the beginning of their careers and who want to make a long-term career into a meaningful tech engagement. So that's our approach, and we are getting a good response in terms of hiring and scalability.
Great. Thanks a lot, sir. Thanks a lot.
Thank you. The next question is from the line of Prashant Sridhar from SBI Mutual Fund. Please go ahead.
Yeah. Hi, good afternoon, sir. Am I audible?
Yes, please.
Yes, sir, you are.
Yeah. Sir, on the various partnerships that you enter, wanted to understand two things. One is how do you differentiate yourself, because every NBFC would be looking to partner with somebody like a Paisabazaar, for example. And number two, generally, do these partnerships come with some sort of FLTG arrangements? If you could highlight those.
See, our idea of partnership, Prashant, is, as I mentioned earlier, is to reduce the cost of acquisition and deliver a risk-adjusted return, which is superior to our normal channel, and also becomes complementary to our branch distribution network. Now, in terms of how do we really identify or differentiate ourselves, so we'll have two-way approach. One is that we are also clear that which are the partnerships that we want to enter into. We want to get in partnerships with the players who have almost similar ethos like us, who have, in our opinion, while we may not be experts to comment on that, but we make our own assessment that what is the longevity of this business model and what is the sustainability of this business model or the company that we are partnering with. Now, in terms of our own ability and how do we differentiate ourselves is the speed of integration with their systems. So that's where the largest differentiator, if I may say, in the success of any partnership will be how fast one is able to integrate, what are the basically the credit underwriting teams on both sides, whether they are on the same page, and the SOPs defined upfront to deliver almost 100% STP, if I may call that. So these are the differentiators that we are looking at, and we continue to. I shared with you that the very first partnership that we started has given us very good results basis these principles of operating.
Sure, sir. No, that was pretty helpful. And what about the FLDG portion?
I would really not want to comment on FLDG and all that. See, we have to make sure that we okay, let me tell you something else. We evaluate every partnership from the perspective of whether it is giving us the desired ROI or not. So that's the single metric on which we measure any partnership.
Sure. Fair enough, sir. And just one data keeping point. If I look at the organic disbursements of around 1545 crores, which product would take up majority share? And is there any disbursement to the discontinued segments?
No, as we said, defocus, then we don't disburse, right? So that's very clear. The second part of the question, actually, the disbursement ramp up has been pretty secular across all the segments, whether it is pre-owned car, whether it is personal loans, business loans, whether it is affordable home loan. Everything has been growing at a pace what we had anticipated. So there is no disproportionate growth. And see, as we have defined ourselves and what Sanjay was earlier mentioning in terms of a mix of secured and unsecured, we also calibrate that irrespective of what could be the opportunity available at a certain point in time.
Sure. So, and lastly, on the management front, are you like now done with the hiring, or should we still expect some more hiring to happen?
So the senior management hiring is pretty much complete across Fincorp and housing. The middle management strengthening is an ongoing exercise which will continue to happen depending on what opportunity, what kind of business do we really see in various geographies and various products. So that will be an ongoing exercise. But for the senior leadership, you may assume that it's largely complete.
Sure. Great. Thank you so much, sir. This has been helpful.
Thank you. The next question is from the line of Tushar Sarda from Athena Investment. Please go ahead.
Yeah, thank you for the opportunity. On slide 7, your presentation is given now.
Sir, we can hear you. You may please go ahead.
Hello, can you hear me?
No, sir, your audio is not audible now.
Hello, can you hear me?
Yes, sir.
Hello.
Better. Thank you.
Hello.
Yeah, we can hear you, Tushar.
Yeah. So on slide 7 of your presentation, you've given a vision to reduce cost of funds by 250 basis points. So would this result in increase in NIM? That's question 1. Second is, what is your current cost of borrowing and average yield on assets?
Yeah. So as far as the 250 basis point reduction is concerned, a reasonable part of this has already happened. So about 180 basis points across term loan and CC lines put together, the reduction is already there. Now, obviously, whatever reduction was carried out, say in Q3, the full impact of that will get reflected over a period of time. So we expect another 20 basis point of reduction in cost of borrowing in Q4 over and above 100 basis point, which had happened in Q3 on normalized basis. Yeah. The cost of borrowing, like you said, that it was 8% for Q3. The incremental borrowing, which is happening at sub 6.5%. We have about 2,200 crore of earlier borrowing, in the form of instrument. So that will run down over the next 2 to 3 years period. But I think the amount will incrementally become insignificant with the growth in book and the incremental borrowing taking the larger share. In terms of NIM, we talked about in terms of yield. So on steady state, our yield should be between 13.5 to 14%, and NIM should be in the range of 8.5% on steady state basis.
Okay. Thanks a lot. And I saw that you've not given quarterly balance sheet. Any reason for that?
So no, I think basically in an NBFC, the lending business, the book and all the numbers which are important, the parameters have already been captured. So there's no specific reason. Okay, it was just to kind of reduce number of slides.
Okay, thanks a lot.
Also, in case you want to understand more, Tushar, we can engage on a one-on-one in case there are still any questions around that.
Yeah, I have been trying and I have been traveling. Actually, I know Sanjay for a long time. So I've been trying to visit, but unfortunately it's not happening. Thank you so much.
Yeah, thanks.
Thank you. We take the next question from the line of Agam Shah from Raj Trading. Please go ahead.
Yeah, thanks for the opportunity. I just had a simple question. On the slide number 22, as you say that as per the RBI circular, an amount of 550 crores should be added to GNPA. So the number we are seeing right now, is it added or will it be added in the next quarter? How do you see this number?
It's already added in the GNPA reporting, which has happened to the regulator. But we have to differentiate between bucketing and GNPA to the regulator.
For an NBFC, Ind AS is the guiding accounting methodology. So GS3 is a number which you can look at from the health of our book. Yeah. The GNPA number is also given in line with the circular.
Okay, so 492 crores is the GNPA which is on the current book as per your slide.
Our gross stage 3 is 495 crores. Yeah, that is the gross stage 3. Because of the circular, the GNPA number would go up. So the 552 crore will get added to this number to arrive at GNPA. However, this 552 crore book is also behaving pretty well. If you look at even stage 1 book, a part of the stage 1 book is also featuring in this 552 crore, and the collection efficiency of this 552 crore is 107% in December.
Okay. So what would be the correct number to look at it?
Also, we have given all the numbers. We have given GS3, we have given GNPA. As far as the economic impact of delta increase, because of the circular is concerned, there is no economic impact. We continue to carry provisions which are far higher as compared to IRAC provision requirement.
Okay. Thank you, sir.
Yeah. Thank you.
Thank you. Ladies and gentlemen, due to time constraint, we take that as the last question for today. I would now like to hand the conference over to Mr. Kunal Shah for closing comments. Over to you, sir.
Yeah, sorry, just prior to the closing comments, I want to touch upon this last question on the regulatory norms. So when do we see it converging with the stage 3? So maybe it's like 3.8, 3.9% extra GNPA. So how much time would it take to converge? And are we realigning the business processes and the ground staff to meet these norms? These are more technical, and we should be okay with this kind of a collection efficiency which is there.
So look, Kunal, two ways to look at it. One is that these are basically regulatory reporting norms, and these are two different accounting standards. So staging and bucketing is more from economic impact on the asset, and the IRAC norms really consider about a certain way of classifying the assets. So if we look at really converging, it may take next 1.5 years to even see that if there is any convergence. But as long as the accounting standards what we are following are Ind AS, so frankly there will be always be a difference in terms of GS3 or the GNPA numbers that you look at. However, what we have started doing, and that is anyways irrespective of the RBI clarification on harmonization of norms, is that we are anyways looking at zero bucket collection efficiency, and that continues to improve, and that's what we will continue to focus. If that will help in little bit on the regulatory reporting as well. And as the product mix also changes, there will be some movement towards harmonization of these two. But really, you cannot ever compare these, Kunal. you'll not be able to compare these and say that they need to necessarily converge.
Yeah, sure. The only thing was maybe almost 30% of stage 2 is there. Okay, so now when we look at stage 2 at 30% and this is 3.9 or so that is almost 30% of stage 2 getting classified as GNPA.
So and that's what I think Sanjay mentioned, that we carry almost about 16% of provisioning cover in the stage 2, which would be safely assuming that is the highest among the highest in the industry. So we follow completely the process of expected credit losses basis the PD LGD, and we follow it to the T. And therefore, we are confident that economic impact of any of these things will be negligible.
Sure. Yeah. Thanks. That helps a lot. And thanks for patiently answering all the questions and articulating the medium term to the longer term strategy. And thanks all the participants for being there on the call. Thank you.
Thank you, Kunal. Thanks everyone for a keen interest in participating in our analyst calls, and look forward to a continued engagement with all of you through this forum, as well as whenever there are any individual requirements on a one-on-one. Thank you so much and have a good day.
Thank you very much. On behalf of ICICI Securities, we conclude today's conference. Thank you all for joining. You may now disconnect your lines.